From Washington, this is the Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, August 5th, and you're listening to the Macrocast brought to you by Hamilton Place Strategies and Markets Policy Partners. I'm Tony Fratto. We have Brendan Walsh and John Fagan with Markets Policy Partners with us, and Matt McDonald, as he is from Hamilton Place Strategies, as he is with us on every jobs day. And Matt, you and I were talking yesterday evening, and I said, or at late afternoon, right around the time that I know from my time at Treasury and you at the White House, that the Treasury Secretary gets the information from Bureau of Labor Bureau of Labor Statistics of what the jobs numbers are, and I said they know what the jobs numbers are now, and we don't.
And now we do.
And now we do, and they must have had a really nice evening, a good dinner, nice sleep. Janet Yellen probably was able to go to sleep with, or at least one thing to not worry about. So now we do, and now the whole world knows that it was a blowout jobs report. Or nearly say, something about the number being on a bingo card. This was not on anyone's bingo card. There were no bingo cards with a 5 handle on it.
The consensus forecast was mid 200s, and the report doubled that up. So final number was 528,000 new jobs last month. The revisions in prior months were pretty negligible, as I think 20,000 and change.
But up. I mean, they were
yes,
modest.
Correct. Modestly upward. The unemployment rate ticked down from 3.6 to 3.5%. It's worth noting within that the labor force participation rate went down, which is interesting, something to keep an eye on. Probably not the direction that we want things going. It ticked down from 62.2 to 62.1, and it's worth noting that even as we're creating a lot of jobs, and that was true both in the employment survey and the household survey, is that the labor force shrank. There were fewer people attached to the labor force last month than the month prior, and that introduces some complications. Biggest driver of jobs gains, again, was leisure and hospitality, almost 100,000 of those. It's worth noting that government jobs were up, and that hasn't necessarily been the case every month. Average hourly earnings year over year is up 5.2%, which is, healthy, and I would say kind of like moderated. I don't think that's going to freak anyone out from an inflation perspective, but it's ticking up at a healthy rate. The other thing, I don't normally do this, but I'm actually going to read verbatim from the BLS release on this. Total non-farm employment has increased by 22 million since reaching a low in April 2020 and has returned to its pre-pandemic level. So it is noteworthy that while I think it's fair to say that the after effects of the pandemic in terms of supply chain disruption and jobs and all the rest of it, when we pause the economy, are certainly still being felt, it is worth noting that we have passed a big milestone.
The only other one I would add on that front too is that healthcare and social assistance added almost 100,000. And that's a little bit more of a COVID thing than a macro indicator. Hospitals were having a hard time hiring people because it became such a miserable job to do.
I'm going to start with this. So is this a good jobs report or a bad jobs report?
Depends on what you think the Federal Reserve is going to do with this number, right?
Why should we care at this point?
Well, the markets are responding in sort of an opposite day, kind of through the looking glass response. Honestly, we futures, S&P 500 futures dropped like a stone as soon as that number came out, and Treasuries sold off. Treasuries are taking a beating. And essentially the narrative is, as we've explored in Macrocast after Macrocast this year, the markets are very concerned about the economic impact of the Fed's inflation fight. A big jobs number increases the likelihood that the Fed is going to stay aggressive, and the markets have priced that scenario in as raising the risk of a hard landing, and so that's why you see the negative.
It is. That is all correct, and I think it is interesting to ask what will prevent a hard landing. What is the economic mix that will result in a soft landing? And it's not clear. It's not clear to me that. I mean, obviously, we've got we had 2 quarters of negative GDP. We have a lot going on that was driving that with inventories. At the same time, we have robust job growth. It's an interesting. I always in this economic environment, I always go back to my operations classes in business school and the bullwhip effect, and just how long when you get lag times and how weird the effects of that end up being. And I think that's a little bit of where we are. But there is a world in which a robust job market becomes the recipe for a soft landing, where even as the rest of the economy kind of pulls, it reacclimates, that consumer spending holds up. The counterfactual to that would be that if we see the inflation effects that we've seen in the supply chain migrate over to the service sector side because of the job market dynamics, that could be a much more complicated exercise for the Fed to tame.
Yeah. And we have to remember that, policy tightening works with a lag. It's 4 to 6 months. The other thing, so this was a wonderful jobs report, but the way our labor market works is we don't slowly go down. So in 2006, the March report was released on Good Friday, and it was something like 325,000. That's when we became aware that we had this housing problem, and some people thought it was a big deal. Some people thought, it's only a couple $100 billion, we'll be able to do it. From there on, we started having negative because the housing hit. So we don't go from 500 to 400 to 300 and slowly down. You kind of hit a wall and it starts. So if we're going to hit a wall from the Fed policy tightening standpoint, it's going to be in the coming months. So I put a little caveat out there that just because July had a strong strong labor data doesn't mean that September will.
Well, all we have are caveats. What are you talking about?
I know.
What do you mean a little caveat?
This
is just a world filled with caveats. That's what we're living in.
What's obvious is no one knows anything. So it's
and that's the main point. Just because July was good doesn't mean August has to be.
I think August is going to be good too. Here, I'm going to say, as long as I can take the opposite view on some. I actually don't think the market is worried about and first of all, talking about the market is it's like one thing, but I don't think most market participants are really worried about a hard landing, to be honest with you. I think it's reflecting it's harder to earn a return as the cost of capital is increases, right? So if we if rates are rising, then the hurdle you have to clear to earn an expected return on all kinds of investments just becomes harder. And now that's helped by sort of nominal growth and inflation actually also, right? So it's like getting those real returns, but it just complicates that. And I think that has a lot of market participants sort of rethinking on everything, including portfolios. But I don't think people are real. I don't think a hard landing is the biggest worry. And I haven't found anybody who has a wide variation on where the destination is in 2023. So we kind of know we're going to end up somewhere in between 3.5% and 4%. That's I think broadly expected, unless you guys are seeing something different on that. But that's kind of what I'm seeing is something in 3.5% to 4%. We know the destination. The speed to get there kind of matters. My view is actually the best thing for the economy is to get to the destination sooner than later.
So on that front, going back to our discussion last week, if you were Fed Fed Chair Powell, are you happy that there's no August meeting, or would you like to have an August meeting?
I still would like to have an August meeting. I would still
No
rather.
way. No way. I'm taking
No question.
I'm letting it ride.
Yeah. You would want to do 75 or so in August, and
I would have wanted when they started their rate
meeting.
cycle 6 months ago. I would have liked them to say, and we're adding an August meeting because we don't want to. We're in a dynamic environment and data are changing.
I totally disagree. I think that because of the lag,
you should have been on last week, Matt. The fight was last week.
I got things to do, man. I think that the reality is that, like, you, with the lag effect, is that they benefit from getting more information. So I just think in an environment where things are changing a lot, I think like a built-in pause that allows you to recalibrate and assess is helpful.
Hey, can I ask Brendan?
Brendan,
can I just ask you a question real quick though on this as we think about August? Also, is what are volumes like? I mean, they thin in August also,
because
right?
all of Europe goes on vacation, and now really the U.S. has kind of followed the same tack, and everyone's on vacation, so volumes are going to be very, very muted. So that can be a good and bad thing. As
like reading a lot into,
you probably do nothing. But if some bad things happen, we could overshoot to the downside because a few market participants can kind of push things one way or the other.
Yeah, and we've had a very that's always the motif. The rookies manning the desk in August, where the managers are all out on the Hamptons, and so you get shallow liquidity and you get whippy moves in a year like this where we've just had such a very difficult first half. There is a lot of fatigue out there. The negativity got very, very thick into the early part of the summer. And, when you see sort of knee-jerk reactions to, we're talking about what we're seeing in just an hour past the issuance of this data, it does tend to wash out in later trading. Our expectation is that the fears are founded that this is driving while looking in the rearview mirror. If you're making policy, based on July non-farm payroll numbers, but you've just heard earnings season and company after company talking about, cutting their headcount, slowing down their hiring plans. I mean, essentially everybody knows that the labor market is going to soften, right? And so you'd rather just see it begin to happen in sort of a gradual fashion. But as Brendan said, it doesn't happen that way. And this data really underscores that.
But that's an important point, because the forward-looking indicators for the job market are also showing slowing. We were hearing announced layoffs and things like that. But even more importantly, not just the forward, but the current-looking indicators into the CPI and inflation have come off a lot. Commodity prices are down considerably in the last 60 days. So,
knowing that
the jobs market today, justifiably so, what's really going to drive the Fed's decisions is what happens with the inflation.
There's obviously the stories on layoffs specifically centered around tech world, but clearly that's not what we see in the numbers right now. And I think and
certainly not on the services side.
And I would say that, like, one of the, in the spirit of everybody always fighting the last war, I think that there is plenty of corporate leaders who are feeling burned by the labor rebound and whiplash, and the having too few workers is a problem too. And so we may find that the labor force may be stickier in the softening than it may be in other years. Like, I don't discount that possibility. It reminds me a little bit back in, I think this was a little bit more of a political exercise than a markets exercise, but back in the 2000s, there was a lot of talk about the jobless recovery. This may be the full of jobs recession. Like there's like a little bit of a twist on this stuff that it's not, I don't know. I mean, I know that, I obviously in like earning calls and planning and whatnot, there's certainly plenty of discussion around pricing and inflation. There's a little bit of softening on the job side, but we're not seeing it in the numbers right now. And it's not clear to me that that's going to be like a major strategic point. I'm not sure that that's how everybody's going to think about weathering whatever is ahead in the economy.
The other important point on the tech layoffs is that the headlines come across, whatever, Amazon or when you actually read the article, those layoffs are from the sales and marketing side, which got a little frothy. If you're one of the people that, are the software engineers or the hardware engineers, there's no shortage of those people. And you have as many jobs as you want, and you can really name your price. And that's probably more important in terms of the wage discussion rather than, you laid off a few marketing people.
It was a Whopper of a report. I'll say that. I mean, we could spend the rest of the day diving into it and guessing about the path of things like, labor force participation rate, which I think there are a lot of surprises in there too that we have to sort out. But let's come back to those. Let's come back to those things. We have some other news this week on the fiscal front. So why don't we take a break and come back and talk about the Inflation Reduction Act.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
Okay, back on the Macrocast. Hey guys, the Inflation Reduction Act, the misnamed, I'm going to say, Inflation Reduction Act, because it has nothing to do with inflation. It is a climate subsidy bill, which is like I'm concerned about climate change and man's contribution to the warming of the planet. Although I have problems with the way they do it, and then some significant or some tax increases. The way they call it, the reason they're calling it an Inflation Reduction Act is that the idea is that the tax increases create fiscal drag that would reduce inflation, and also with some specific measures in things like prescription drug pricing and a couple of other things that would.
So if inflation doesn't go down, is the act then not successful?
Well, it's kind of a smart political decision because for the next 2 months,
the point of this is advertising, right?
Is going to come down because gas prices are down so much.
Yeah.
So, it's a pretty good.
It's working.
Biden administration. You got strong
declare victory,
and you're going to be able to tie, a $450 billion spending to gas prices coming down.
It's in front of that parade, right?
Yeah. It's also just easy to say my opponent just voted against the Inflation Reduction Act. It's a good,
which we know from John Dick's data is the biggest thing on people's minds right now.
Yeah, let's be clear. Let's just settle this for a moment there. Like it's the net fiscal drag is like something like $100 billion over 10 years in an economy where we're at a $22 trillion economy, GDP.
And you're right. It's over 10 years, right?
Over 10 years. So I mean, you should. I don't want to do the average growth compounding year over year of how big the economy is going to be in 10 years. But needless to say, here's the way I'm going to put it. If I took all of my loose change right now and threw it in the East River, over that 10-year period, it will have somewhere close to the same impact on inflation as the Inflation Reduction. All right.
And also,
now,
remember,
there's some
not tax increases. These are closed loopholes.
Loopholes. Yeah, but, although I have to give props to the senior senator from Arizona, Kirsten Sinema, for standing her ground on carried interest. I know it's a lonely place to be out defending carried interest.
You please give us your defense.
But I'm happy. I'm happy to defend it. This is. Everybody keeps saying. It should be taxed like regular income. It's like it's not regular income. It is nothing like regular income. It's capital at risk. It's risk income that could go to zero and very frequently does. And it's like this situation where everybody says, well, like, oh, it's a tax breaks for the rich guys. Like, the rich guys are the ones who succeeded. You know who doesn't get the carried interest? The failed fund managers. It's like saying
you're out of business.
It's like saying all baseball players get paid a lot of money. It's like, it's not true. Major League Baseball players, the successful ones, make a lot of money. Minor League Baseball players, the ones who fail, don't. And it's the same here. So it's not
unless
like
they do that pooling their risk things with the contracts. That's been the baseball pay innovation.
But even that is just, that's major. It's in just the major leagues. It's not like they're not doing it in. They're not doing it in minor leagues. Like that, you have to get to the major leagues. So that's why I always say, like, what's carried interest doing for the unsuccessful fund managers? And the answer is nothing. And by the way, no one's giving them money to manage anymore either.
No, I totally hear your point. But if you were just put in charge of be able to write carried interest, would you leave it the way it is, or would you, tweak it some ways?
I would leave it the way it is. What would be the tweaking?
I don't know.
I can't.
A lot of people criticize it, that it's a huge loophole.
Yeah, a lot of people criticizing it don't know what they're talking about,
while still keeping the main point that you're talking about, that this isn't ordinary income.
Yeah, it's not ordinary.
I just think the framework is different. I mean, they're just looking at the tax code and saying we need more tax revenue. And what is a saleable approach that can give us more tax revenue that we can actually pass. And
if that's what they were saying, John, it would be more honest, right? And which is, by the way, again, credit to cinema. Yeah, no, look, I mean, there are all kinds of ways that you can tax all kinds of things. And so she substituted another tax that I'm not really fond of either, which is a 1% excise tax on stock buybacks, which is government putting its thumb on the scale of capital allocation decisions by corporations, which I think doesn't make sense either and is not efficient. But we'll fight about all these things. But I don't mind.
We fight about the minimum corporate tax too.
Yeah. The book tax. Yeah, the book tax.
So this to me is like the problem with a lot of these things is when the political shorthand is you apply like a personal taxing structure to a corporate structure that doesn't make sense. Like government spending shouldn't be thought of as like your kitchen table spending, even though that's the trope. And corporations have years where they don't make money. That's why sometimes they don't pay taxes, because if you don't make money, what are you paying taxes on? And it's also worth the irony of some of the structures of this is that, closing loopholes, quote unquote, is usually incentives that Congress and the government have put in place for companies. And in this structure, the way they were talking about it, they specifically had to exempt all the environmental related incentives that are in the rest of the bill so that those don't just get excluded from the quote unquote minimum, so that they don't eviscerate their own incentive structures. It's all like convoluted and just kind of doesn't make sense.
In terms of the politics of it, though, Matt and Tony, you guys are more plugged into that side of it. It looks as though, Manchin obviously was kind of he's been a very challenging senator to pin down on his views. He's been kind of all over the road on this, although he wouldn't characterize it that way. He's been very consistent in his own mind, I guess. But the politics there was also the legislative dance between the CHIPS Act and pulling a fast one, some people say, on McConnell. But it's if it does pass, it's a big win for the White House. When you guys take a look at the politics of this, do you think it's going to be a potential part of a game changer for Democrats? Or is it, I think
it provides some helpful like narrative lift in advertising in the midterm cycle. I think fundamentals on the ground are probably pretty baked at this point. I don't think the actual impact of the stuff is going to happen before the election, which is fine. I think that they can do. I think in terms of the the fast one and the shiv that they pulled on McConnell, I think that if this were at the beginning of the Congress, that would actually be a bigger problem to getting stuff done. I think that at the end of the Congress here, with the potential to lose, I'm likely losing the House and maybe a flip in the Senate, I think they've made the calculation of kind of like, well, whatever, this is kind of the end of what we can get done and we don't care. So I think that was probably it makes sense from a political perspective there. It's a win for the White House, but I think I'm not sure that changes the fundamentals on where perceptions are around Biden and his approval ratings.
Yeah, I think it's mixed. I mean, I think they went through a period of getting stamped with incompetence, right? That's where they were. Like after Afghanistan, declaring COVID essentially over, in July of 2021, and then having it roaring back. The long path to this reconciliation bill, which looked like a path of failure, right? Started at $3.4 trillion and kept getting tripped along the way and shrunk. And those battles, like I said, a problem on the border, so they had an air of incompetence to them. Now you look over this most recent period and you have people starting to talk about competence, right? Like they've gotten some bills done. They get the CHIPS Act done. They can still go out and talk about infrastructure. They got the Good Jobs Report. They got al-Zawahiri. They had like a sort of a run of successes, and they get a chance to go out and do that now. So I think that puts them in a stronger position than where they were, undoubtedly. Republicans still have a pretty good story to tell, because even though I have been hammering on the White House to go out and talk about jobs, they haven't done a great job of doing that. Republicans have been laser focused on their message that this is a tax and spend administration that has caused awful inflation and probably a recession. That is a really easy message that they can go out and sell. Democrats now have a chance. Always remember, like whenever you're in any kind of battle, they're always dynamic environments. The other side are sentient beings who can think about different things to do to counter you. And so I think Democrats have a chance to now go out and counter, and then they have a little bit of wind at their back. Also, it's hard to overstate or to understate, because I don't think people really know very well, but the Kansas City results from the jobs decision on abortion, there are certain pockets, like in certain elections, like in the collar counties of Philadelphia, that are going to be where Democrats are going to be helped in certain races. And so we'll see where that goes. But I think they should feel a lot better today than they did a month or 2 months ago. They're going to go into the fall and the election season with at least some better artillery than they had before. Hey, let's take a break and come back. The other big news that got tons of headlines this week was the Speaker, Nancy Pelosi, going to Taiwan. And we got some breaking news on that this morning we'll talk about on the Macrocast.
Markets Policy Partners provides sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com. or visit them on Twitter at MarketsPolicy.
All right, we're back on the Macrocast. Guys, I think I said, I went to Taiwan back in 2019 and I didn't get any attention at all. There were no recommendations, nothing, no market movements. Speaker Pelosi went with lots of drama and elevated tension. There's a lot of debate as to whether it was the right thing to do or the not right thing to do, and whether the White House did or did not want her to go. Were they just putting up a show of being irked by it, or were they actually irked by it? But what we got this morning was, a lot of people were waiting to hear what the Chinese would do. We saw this week that one of the things that they did was to do military operations off the coasts of Taiwan. They did that. That's a regular thing for them to do, and it's kind of dramatic, but doesn't really change things over there. It's just it's more of a show of force. And then the other thing they did today was to come out with a list of actions that they would take, which to my mind were fairly measured. I think everyone should look at this and say, this was a measured response by the Chinese. They've done the things that one would expect them to do, and that nothing here is any kind of game breaker. And it involved things like canceling certain meetings and canceling cooperation on some, tracking some anti-crime efforts on money laundering and drugs. And these are not to say these are not important things. Stopping, some collaboration on climate-related matters. Again, important things in their own right, but not game breakers in any way. I think anybody who's been paid attention to the Chinese would understand that this is a pretty measured response. They're not going to see big economic sanctions, or this is the way I read this is their effort to actually de-escalate the situation if this is where it stops. Did you guys have a different view on that?
Well, I agree with what you said in terms of the necessity of China. Everybody knew that China had to respond in some way, shape, or form, and the current list of actions, the military maneuvers, and so forth, as you say, relatively standard. The question in people's minds is, is this where it ends? The Chinese Foreign Ministry came out and said, "There's more to come. We're going to continue our countermeasures," and that is. From a financial markets and global economic perspective, geopolitics doesn't intrude until it starts to hit supply lines, right? And that is the headline, the kind of headline that people are really focused on around this, which is, these military maneuvers, as kind of bellicose and threatening as they are, still, it's a very minuscule tail risk that they actually escalate into something, really ballistic. But they are impeding shipping lanes, and concerns about whether whether this can amount to a hang up in the global supply chains. There's questions about whether the chips are going to be able to make their way to the Chinese iPhone. The iPhone fabrication centers in mainland China and so forth. And so there's definitely this sort of. And surely the Chinese are well aware of this, as these key supply lines run right through those straits and impact potentially global economy, global commerce, and major companies around the world. So it's something that the lesson from the last few years has really been about the Murphy's Law has been coming into action a lot more than people expect, and sort of these unthinkable and terrible tail risks have materialized in so many different ways that people are forced to contemplate worst case scenarios again and again. And that's the kind of thing.
Tony, I agree with you on the overall assessment of the situation and the response and that sort of thing. The thing that I'm beginning to wonder about is just the Chinese economy and how that intrudes on and affects national security and foreign policy calculations over there. I don't think that Nancy Pelosi's visit is going to be the flame that lights the spark here, but I do worry that decades of Communist Party legitimacy predicated on you be cool and we grow the economy. If that end of the bargain starts fraying, either the bargain falls apart or they need to look for a different end of a different thing to deliver to the people. And that is a recipe for a lot of uncertainty and a lot of danger.
It is. That is to me the real big question, and why I think now to John's point, I think we do have to consider sort of fat tail outcomes that we maybe wouldn't have considered that way in the past. However, the rational decision making in China right now is not. They don't have a lot of room to sort of have these kinds of fights given where their economy is right now. I mean, they are The Chinese put out their estimate for GDP growth for the coming year, at 5.5%. They made the point of saying that this was a voluntary goal, right? Which is kind of the way we all think about all things economic, that all things are a voluntary goal. Because the implication has been like that if the Chinese came out and said growth next year is going to be 6%, then you damn well better get out there and get 6% growth, because that's not just an estimate, it's a goal.
I do kind of appreciate them dropping the veil on that.
I did too.
No. This one's voluntary. It's cool.
Yeah, 5.5% if you can get there, and it'll be good if you can get there. Whatever you can do, a little taste will be good. So that's kind of where they are. But like the Chinese economy is not in great shape right now. They are actually if there is a global recession, it is more because of China's self-inflicted wounds than anything. China as an economic engine for the global economy has been absent for a while because of their response to COVID and their disruption of global supply chains. So, so they're not in a great place to elevate this. Yeah.
Around the corner for them is the end of the demographic dividend in China, if that hasn't already happened. So
for sure.
It's not great timing all around.
Yeah. So that's right. So to John's point is absolutely right. Like disrupting the supply chains, they could do it, they just can't do it for long because they need to be selling iPhones and other products. So they could try to, slow down, chips could slow down, but it's not great for China. And they're not running at 6-7% GDP growth right now, where they could take sort of punitive actions with a big cushion. They don't have a big cushion right now. So we'll pay attention to that as we look to the rest of the months. I mean, I guess maybe it's going to be a sleepy month. I mean, every time we think that, something crazy happens. But we'll keep an eye on. No Fed to keep an eye on. I guess I'm the only one who's pining for a Fed meeting this month. We're not going to have that. We'll get some fiscal action, and then Congress is going to go away. And then we'll see how this economy holds up and how markets hold up over the next few weeks with this news. Yeah.
This week was the jobs week. Next week is the inflation week, not just here in the United States with CPI and PPI, but also a number of important European.
Brendan, that's a great. So we have price data coming. What if it's as much a surprise blowout as what we just saw with jobs, and you still want to sit here and say, good thing that the Fed isn't coming in?
Yeah,
we're going to let it rest out there for 6 weeks.
Right, because we know that the headline number is going to be small because just simply gas is down, 15%. So the focus definitely will be on core, and so much of the core has to do with the housing components.
You have way more faith in what we know and what we don't know than I do.
We do know how much gas prices come down.
That's true.
AAA tells us every day.
That's a fact. Yeah.
Everything else is up in the air.
All right, guys. Matt, thanks for the jobs report, as always. John, Brendan, have a fantastic weekend. We'll catch you next week on the Macrocast.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.